what happens is we get a few more over the first few minutes. But thanks for tuning in. And in this webinar, I'm joined by Colin O'Loughlin from Arch Brokerage. Thanks for joining, mate.
Thanks, Ben. Thanks for having me.
Awesome. We were just having a bit of a chat beforehand and pretty excited. I got a personal interest in knowing this stuff as well. So yeah, thanks for sharing with us. But before we get stuck into that content, I'll just give a brief intro if this is your first time joining. We run an accounting firm called Inspire based in Brisbane, and we work with small business owners. And one of the things we do and are pretty well known for is saving a heap of tax. And that tally ticked over to $28 million in the lead up to 30 June just gone, which is something we're pretty proud of. You're on a webinar today, but we actually do these usually one or two a month. Our next one, which is only a couple of weeks away, is on structuring property developments in trusts, companies, and SMSFs. So there's many different ways you can structure property development. And often what we do is sort of get an understanding from the client what outcome they want, and we provide the best structuring advice we can around that, thinking tax and where the profit ends up, all that sort of stuff. So we'll dive deep and share some case studies and that sort of thing in that webinar. And Tay from our team has just popped the link in the chat box if that is of interest to you. Also, if you're keen to explore working with us, the way to suss us out and maybe see if we can help you is to book in a strategy call with one of our accountants. There's phone or Zoom option. Although what's interesting is the take up for Zoom is heaps higher, which is cool. A bit of a face-to-face element to it. And again, the link for that, if you do want to explore, is in the chat box as well. So just have a quick intro to your presenters as well. Colin's going to be doing the presenting. I'll be doing the question asking, I think. But my name's Ben Walker. I started Inspire when I was 23, so about 10 and a half years ago now. I'm an award-winning chartered accountant with over 17 years experience. And late last year, I authored the book Wealth for Life. And I've actually got another one coming out by the end of the year, which is pretty exciting. And then I do want to do a brief intro for Colin. So Colin O'Loughlin is the director and a mortgage broker at Arch Brokerage. He's an award-winning mortgage broker, winning the Newcomer of the Year in 2021 and finalist as Sole Operator of the Year in 21 and finalist as Best Brokerage Under 5 Brokers in 22. Awesome stuff, man. And over 15 years experience in banking and finance. So really looking forward to Colin sharing his knowledge. So thanks again, mate.
My pleasure.
Cool. All righty. Now we're going to cover broadly three topics, and I'll hand it over to Colin in a moment. But we're going to chat through understanding what this whole mortgage cliff thing is. The second thing is also like examples of how repayments have changed after your fixed rate expires, and also what do you do about it? Where do we go from here, and who do we chat to make sure we're getting the best deal? So I'll hand over to you, Colin.
Excellent. So we'll start with the mortgage cliff. I know that this word has been thrown around a ton over the last 12 months in particular, and it really relates to the fixed rates that are going to be coming off. What we saw just around when COVID struck was we saw fixed rates sort of bottom out. We saw some rates as low as 1.79, 1.89, 1.99. So, extremely low as to where we see the rates today. And as you can see there's actually in total over $350 billion in home loans coming off fixed just in 2023. Now we're about 50% of the way through those fixed loans rolling off. The good news to report there, I guess, for the economy in general is the arrears are still relatively low. They haven't seen a spike with with those loans coming off fixed.
And just
But
clarify that arrears,
yeah,
is that like a measurement of how much of the population have defaulted on there or haven't repayment?
Exactly right. So it's essentially saying that people are keeping up to date with their loan repayments, which is excellent to see. I think one of the good things, you know, the RBA moved things relatively quickly, as we saw month on month on month. We saw increase and increase and increase. I do think that there was some time to plan around budget and what things were going to look like. The other side of it is from the bank's point of view, whenever we were doing when we do applications for the bank, they've always assessed things with a buffer in play. So from an affordability standpoint, we have actually seen the cash rate and interest rates increase by around 4%. So, that's a little bit higher than where the buffer is. But, we can only hope during that time that incomes have gone up a little and people have just come to terms with what their repayment's going to look like. And I guess that's really what we're going to go through today. So from the fixed rates point of view, just to give you a bit of a landscape of where it was and sort of where it is at the moment, the fixed rates were around sort of that 1.9 to 2.29, which is sort of what everyone was taking on during those periods about 2 to 3 years ago. So we saw a lot of people lock in a lot of their loan. More times than not, it was around that 70 or 80% portion, and then maybe leaving a little bit variable, providing the flexibilities of, having a large portion locked in with the rate low, and then having the variable portion still giving you access to pay back the loan a little bit quicker if you want to have access to things like offset accounts. So that's sort of where it was around that 2-3 year ago mark. And then we've seen over time as the RBA's increase the cash rate, the lenders have passed that on. And sort of as at today, we're sort of seeing the variable rate sit around that 5.896%. We're going to touch on it a little bit later, but the one thing I would say is if you're looking at that rate right now and you're thinking, well, I'm not even close to that, it's a perfect time probably to reach out and, we're going to go through it in a bit more detail, but certainly probably need to have a look at it.
Yeah.
So overall, we've seen the repayments from those loans that are going to be rolling off. It's about a 60% increase in the repayment in what you're making. So it's quite a big jump, but it's all about planning for that and looking at your budget and seeing where you can fit that in.
Awesome. All righty.
Okay, so I've just brought up some examples of how the repayments, may change or how they have changed. I've sort of used a baseline of about a $750,000 loan, which sort of seems to be the average deal size as we've seen property prices increase, which is pretty crazy statistic. So for a loan that was $750,000 on a rate of 1.99, we've seen that the repayments for that were about $2,768 per month. For that same loan amount at a rate of 5.89, we've seen the repayments would increase to $4,443 per month, roughly. So overall, it's an increase of about $1,675. So, quite a large chunk, but we can only hope that, I guess, that's just going to go into the forward planning. The one thing I would say with that is if you've got something coming off fixed, whether it's in the next couple of months or the next 12 months, now's probably a great time to start having a bit of a look at what they're going to look like. So if you've got some specific figures that you need looked at, you're obviously more than welcome to reach out.
Sweet. All righty. And then the good old outlook, which is a bit relieving.
Yeah, I think it's maybe we take ANZ off the board, but I think overall it looks relatively positive as to what the economists are saying from the big four lenders. So this is all based around the cash rate. So obviously it's not the interest rate that you're getting because there's a buffer that's built into that. That's how the bank obviously makes its money. But the cash rate just gives us a bit of an idea of what the RBA is doing. So right now, the cash rate is 4.10%. If you look across the board, the only one that is predicting that there's going to be an increase in the next 2 years is NAB. So they're saying that they're predicting there's going to be a 0.25% increase in November. It's probably worth mentioning that, you know, this can be fluid. The bank does update its outlook or its projections on a sort of semi-regular basis, but I think it comes for good reading. So if we look at the likes of Westpac, you know, they're saying that they predict that the cash rate is going to drop 1.5% sort of from today to December 2025. So, you know, there's some I mean, that would be amazing. I think that's going to be good news for mortgage owners. CBA sort of aren't too far off the mark there. They're about 0.5% higher there. They do see it dropping a little bit sooner than what Westpac do. And then we've got NAB, who actually, you know, are predicting that it goes up, but they do predict that it's actually going to fall, you know, a lot quicker than what Westpac do after it does go up. And then we've got ANZ. We'll still point them out, but they sort of think that it's going to remain quite steady over the next 2 years, and that we might just see a 0.25% decrease towards the back end of next year. So I think overall, hopefully, you know, we can take the best out of all of it that's going to happen, and we're going to see rates and then also repayments come down on that basis.
Beautiful, very good. Alrighty.
Okay, so yeah, what options homeowners can consider? So I think the really, and this is the big question that we've been getting at the moment as well, is you know, we're coming off our fixed. What do we do? So we'll just have a bit of a look at you know, what do you do whenever it comes to your fixed rate coming to the end? So what we're seeing a lot at the moment is about at the 2-month mark of whenever it rolls off. It's really a point in which we'll contact our clients as well, but it's assessing the options that are available. So have a chat to your mortgage broker, you know, whether that's us or whether that's somebody else. Have a chat with them. And I think the first spot in which we can start, which is always a great spot, is having a chat to your existing bank. So one thing that we're noticing in the market at the moment is the retention of the lenders has really picked up. So they're really trying to hold on to as much business as we can. So ultimately, it's I think that's a great spot to start, because they want to retain your business. I will put a little caveat in there, a little nugget of gold, I guess you could say. What we're sometimes seeing, and not great from my point of view as a mortgage broker, but sometimes we can start an application for a client, and then they can turn around and say, hey, you know, we lodge the discharge form, we tell them that they're going to be leaving, and then they'll try and trump potentially whatever's made available to you. So one sort of thing that we are using is we are trying to leverage against your existing lender and say, hey, this is what's available out there in the market. Can you come and meet this? I also know that lenders are getting better at, you know, providing their best pricing up front and stopping that toing and froing. Obviously, from a mortgage broker's point of view, we don't obviously want to start doing the work whenever, you know, they're going to come along and then try and beat the business. So we will try and put you in the best position possible to get the best rate, and whether that's staying with the existing bank or leaving, it's really just comes down to the research that's conducted sort of at that starting point that's going to yield you your best interest rate available. So look, have a chat to a mortgage broker, and you know, we can discuss with that existing lender what we can and can't do. And then we will give you a little bit of guidelines around how we can give them one final push before we start actually doing an application.
Yeah, perfect. And I guess you know, even I mean, you helped me through my own process here in the last couple of months, but the bank certainly didn't lead with their best rate. No. A bit of a tickle, but
yeah. But we're noticing that. So. And it's a couple of layers to what we do, but that you're right, Ben. What happens right at the start there is it might be like, oh, okay, here you go. And then it's a matter of like, well, wait a minute, this is what the other lenders are providing us as options to leave. You know, I would say probably 6 or 12 months ago, there was less of a push there. They'd sort of let you go, but there does seem to be a really big emphasis on trying to retain clients. So we give them another push. or we steer you in the right direction to see what they can come up with. So,
yeah, awesome. Okay, cool.
all right. So just, I thought it would be important to touch on the refinancing market. It's the refinancing market is massive, especially in the mortgage broking and just in the lending space in general at the moment. I think what we typically saw with refinancing, while rates were going down over the past, the best part of 10 years, people saw their rates and their repayments going down. So they're probably a little bit more reluctant to look into it. We've definitely seen a large increase the amount of people that are looking to refinance, especially over the last 6 or 12 months, because all of a sudden rates are going up, and it's a really good onus to go, well, wait a minute, am I getting the best deal possible? The beauty of having a chat to the mortgage broker, obviously I'm very biased on this, but the benefit of having a chat to the mortgage broker in comparison to going to your bank is, if you're going to your bank, you might be comparing it against maybe a couple of other lenders, or the bank is doing it based on how long you've been a client. They're going to go, oh, hey, we're going to give you this great deal. But the only real way that you can have a look and see if it is a great deal for you is having access to all those lenders and seeing what rates that they've got available, because they might be offering one thing online, but there are ways for us to discuss with them, especially if you've got quite a bit of lending or you've got good equity in your property. There's ways for us to actually negotiate to get those rates down. So we've got access to over 60 different lenders, which is a massive number. Mortgage brokers have 70% share of the market whenever it comes to funding mortgages within Australia. So what I would say is, have a chat with us, and obviously we can have a look and see where you can and can't save money. So a couple of things that have changed in the refinancing market. So with an increase in interest rates, we've seen borrowing capacities reduce. So a term that gets floated around a fair bit, or has been thrown around in the last 6 months, is mortgage prisoner, which was a big worry for everyone. Is like, well, what, you got a loan with whoever it might be 2 years ago, rates have gone up. Now you can no longer service that loan to move it between the banks. So I guess the next point around that is, banks are changing their policies so that people aren't necessarily stuck with that one lender. So what happens traditionally whenever you're applying for a loan is the bank will add around a 3% buffer on top of what the normal interest rate is. So as you can imagine, as interest rates go up, all of a sudden, let's say we're at the high fives, the bank is now trying to fund that loan based on it being an high 8% interest rate. So what they're bringing in, a lot of these lenders, is they're bringing in, say, like a 1% buffer, or sometimes even a 0% buffer, in order to allow you to look at your borrowing capacity. Does it give you the ability to do that? And move between lenders without actually being held in the one lender all the time. So I think that's a great one that's come out as a part of it. So once again, if you want to see if there's something that you're eligible for on that front, or maybe you think, or maybe you've looked into this process and you feel like, what, I do feel like I've been a bit of a mortgage prisoner, I've got no options. Once again, feel free to reach out. We'll be more than happy to provide you with some options in that space. The other big thing that's happened over the last probably 3 or 4 months is cashbacks have been rife within the finance industry for the best part of the last 3 or 4 years. So there's been a lot of lenders that have had access to cashback options anywhere between $2,000 and $5,000, which is obviously quite a bit of money to be moving between lenders. We are seeing them go away from the market. So we've seen pretty much all your big 4 lenders pull out of that, minus ANZ. There's less than a handful of lenders left, whereas I probably previously we would have said, there's a good 10 or 15 that are offering cashbacks. So we're seeing a lot of the lenders pull out of the market there. So the one thing I would say, it's not always a driving factor, but if you can get a better rate and you can get these cashbacks while they're still around, it can still be a great opportunity to take advantage of the money that's available from the lenders right now.
Very cool. All righty. I think the next slide's on where I sort of at the moment.
Yeah, so here's a bit of an insight. Once again, there's a lot of variables that come into an interest rate. It can do with how much equity you have in your home. So for these ones, I've just based it on, you're having a 20% equity, so you've got about 80% lent against your property. Um, the more equity you've got, you'll find that these rates are going to decrease. You're going to have more options whenever it comes to banks. But here's a bit of a baseline of where it is from the variable market right now, based on a loan amount of about 750,000. So we've got Adelaide Bank at 5.88, Westpac at 5.89, NAB at 5.89, Macquarie at 5.95. I would say in particular, your Westpac, NAB, Macquarie, really great with self-employed clients, which is obviously going to be the large demographic of the people listening to this webinar. So really looking at things with more of a commercial lens than maybe your standard lenders. One of the great things I will add around Macquarie, not pushing any one particular lender, and this is not financial advice, but one of the great things about them that I find with business owners is Macquarie allow you to have multiple offset accounts. So some people like to sometimes apportion their money out, whether it might be, your GST, your tax, or your profit, or whatever it might be. I'll let Ben maybe talk to that a little bit more, but it can be great for splitting your money up, because all those offset accounts, you can have up to 10, can all facilitate back to the one loan. Whereas what you find with a lot of other lenders, and there's a few out there that do that, but what you find with a lot of the other lenders is they'll have one offset account going back to the one loan, which is generally maybe your day-to-day or everyday spending.
Yeah, rather than those big savings accounts.
Exactly.
Business owners' quarterly bills. Yeah, very good. Alrighty, so that's a variable. How about the fixed side of things?
So fixed a little bit high, and you're probably seeing a little bit of you're seeing the same lender with the variable and the fixed. Adelaide Bank are there once again. So we're seeing that they are a little bit higher at the moment. So Adelaide Bank 6.04 for 2, 3, and 4 years. And this is based as at today. We got Bank West at 6.29, 3 years fixed. Once again, Bank West, actually the three under Adelaide Bank, once again, all work relatively well with self-employed clients. We've got St. George at 6.49, so over 2, 3, 4 years. And then we've got ANZ at 6.54 over a 1 year fixed. Probably good to make mention, Adelaide Bank, they'll actually do their fixed terms with an offset account, which is quite rare in the market. And ANZ, for their 1 year fixed, they will also do an offset account linking back to a 1 year fixed loan. So some good stuff there, some good features that can be provided along the way as well, which once again I think is great when you're talking to a good mortgage broker. You find that once again, yes, policy driven, but there can be some good niches out there between the lenders, because different banks do offer different things.
Awesome. And hey, Colin, we just got a couple of questions. If we can,
sure.
Those. So let's say we went and locked in a fixed with St. George for 4 years, and in 2 years' time the rate's like 2% lower. What? Not good. What's the sort of exit penalties or that sort of thing that needs to be considered?
Yeah. So there's no. I mean, there is an algorithm to it, but it is all based around. So what we've typically seen, let's say someone sold their property in the last 12 months, right? And let's say they're on a fixed rate of around 2%. What you find is when the variable market goes up and then you go to exit that loan, there's not a lot of costs, sometimes no costs at all associated with breaking that loan. And that's based on the banks sort of really basing that on, well, what's the rate that you would roll on to when in comparison to where the fixed rate was at. Where you find you sometimes do get into a little bit of trouble and the costs does increase is when your fixed rate is higher than where the variable market now is. Now, it's got to do with cost of funds. It's got to do with how long you have left. How much is the loan amount? So, in some instances, let's say it was 2%, you might be looking at thousands and thousands to then exit that loan. There's no sweet science, but I know the bank have all these have all these things in the background where they punch everything into a calculator and then effectively tell you what the break costs are for it. So that's the one thing you've just got to be mindful of with fixing is you lose a lot of the flexibilities that you get with a variable rate loan. So with a variable rate loan, you've got the flexibilities of an offset account. You've got the flexibilities of paying back extra with no restrictions. With your fixed, it's great because you've got the certainty, but you've got restrictions in how much you can pay back. Some lenders will allow more. And as I've sort of just touched on, your likes of Adelaide Bank and ANZ, they actually offer an offset facility that 100% offsets. You will find some others might have offset accounts, but it might only be, say, 25% of the funds that are sitting in there. But yeah, ultimately it's just weighing up what's going to be best for you now and into the future. And, you've seen where potentially the RBA is saying the rates are going to go. So you've got to also be mindful of that, of weighing up the certainty versus what happens if they potentially go down.
Yeah. Okay. Cool. All righty. And another question from Howard is: does any bank allow offset accounts not in the name of the loan? Sorry, who's on the loan? So let's say you've got a company who you want to offset, $1 million.
No. There are, what you find is a lot of them want whoever's on the loan to match whoever's on the account. The only difference to that is there are a couple out there that will allow it to be in singular person's name back to the loan. So if you've got a joint loan, a lot of them want to see a joint offset account. There are a couple out there that will allow joint loan, single person on the offset account. So you can have some, single ownership, but nothing for a company, unfortunately.
Yeah. Okay. No, fair enough. All righty. Do any banks offer multiple loans over the same properties? Let's say some variable, some 2-year fixed, some 5-year fixed.
Absolutely. Yeah, we do that. We've particularly about 2 or 3 years ago, there was an offering from a particular, actually there was a couple doing it, but they were doing 1.99 for 4 years. So actually we did do quite a few, 4-year fixed, 2-year fixed variable, sort of to balance things out a little bit. So absolutely, you can do multiple loans across the property. We can split that out however way you'd like it. Yeah, those 4-year 1.99s are still laughing. Still got a couple of them on my book that ask me about their variable rate every now and then, and I tell them how good they've got it. So
yeah, absolutely. There you go. Geez. Okay. All righty. Well, yeah, feel free to ask any more questions if you've got them and you're listening on. But yeah, Colin, how do we get in touch with you? What's the best way if if one of the people in the audience wants to have a chat?
Yeah, so feel free to reach out. My mobile number, email. You can also, we've got an apply now button that's been introduced onto the website. So you can literally actually go through an application through the website now, which is awesome. Cool. But the main thing is in terms of our process, how we sort of generally will work is, obviously feel free to reach out. We can have an initial discussion. I can get an understanding of what you're looking to do. From there, I've got a team of people that will send you out an online form, just like the one that's on our website. We get you to fill in some information, and then we get some documentation from you. Then we really, generally, once we've got that back, it's about 24, 48 hours, and then we start to conduct the research, and then we do a bit more of a catch-up. But, as a high level, even if especially, I guess, talking about the refinancing side of things, if even as a start, you want to send through maybe a rate that you've got, who you're currently with, a balance or limit where your property is, sort of those metrics will allow us just to do some initial research for you to go, well, hey, is there going to be some benefit in you having a look at what else is out there? Or even if you want us to go back to your existing bank to give them a tickle, as Ben likes to say, then we're obviously more than happy to do that as well. But any of those platforms, feel free to reach out. We'll be more than happy to have a look at things for you.
Yeah, perfect. Okay. And I guess, a couple of key takeaways for me is, if your fixed rate's expiring, don't wait till it has expired, 2 months out. You can start making some calls and sorting it out. The bank won't lead with its best offer often. I doubt they would. And, Yeah, and I guess for me, another one is it's relieving to hear that the forecast is that the rate's going to drop by a little bit.
Yep. Yeah. Fingers crossed.
Very good. All righty. Well, hey, I can't see any more Q&A. We'll probably hang on for the next 2 or 3 minutes, but that's the end of the stuff we had planned to share. So yeah, we might sort of wrap up. Feel free to give us a follow or a like or subscribe on all the social media platforms. And just a reminder again, if you did join late, that our next webinar is all about structuring property developments and the many different ways it can be done. So trust companies, SMSFs, a combination of all of them we've seen. So yeah, we love that stuff. And if that is of interest to you, that is on the 7th of September. So feel free to register for that. The link is in the chat box. So thanks everyone for joining. Appreciate you sharing your time and your knowledge, Colin.
My pleasure, mate. Thanks so much for having me on.